Hello there, this is the Value Investor. What if I told you there's a simple way to know exactly how long it takes for a company to pay you back on your investment without relying on hype or speculation? Free cash flow. And that's free cash flow payback, which is one of the most powerful but yet underrated tools in investing. And today I'm going to break it down step by step, and by the end of this video you will know exactly how to use it and how to find undervalued stocks and avoid traps and maximize your return. So stay with me. This could change the way you invest forever. Now let's get into it. So investing is about getting more money out of the investment than you've actually put in. So the best way to measure this is through free cash flow. Unlike reported earnings, for example, which can be manipulated, FCF, which is free cash flow, is the actual cash that a business is generating. So this is a good way to filter ideas, and always remember you have to use it alongside other metrics. So personally, I will use this to kind of filter down my choices. If a company is taking too long to pay me back, then that's a pass for me. So I will use this as a kind of an initial filter before I start to apply other metrics. So let's look at what exactly is free cash flow payback. So free cash flow payback period, it measures how long it takes for the company to pay back your investment using its free cash flow. So if you're new to investing, when I'm saying paying back, when you buy a share in a company, you have actually parted with your money to buy a stake in a business. So once you buy that stake, that business is going to generate cash, and that cash is going to be reimbursing you. So as a shareholder, that's what you're doing. So free cash flow is that cash that is available to the ordinary shareholders after everything has been taken out. So the formula to find free cash flow payback is the market cap of the stock, which is how much the business is worth in a whole, divided by the annual free cash flow. So if the annual free cash flow is high, it will take lesser time for you to get the money that you've paid back into that share, all things being equal. So this is simplistic. It's for you to do that first initial screen of your companies. So an example calculation. So let's say a company has a market cap of 10 billion and annual free cash flow of 2 billion. The free cash flow payback period will be 5 years, and that's quite good. A lot of the companies I have analyzed, they will have payback periods in the teens, in the 20s, in the 30s, and some of the beloved companies, which I'll talk about later, will actually have quite more than that. So less than 5 years is very attractive, 7 to 8 years is reasonable, and 15 plus years is quite long. For me personally, look, I want to be retired in the next 10 years, so I'm looking for something to have paid me back within within that kind of time frame. So 15 years is quite long for me, so I will avoid those unless it's offering very high growth opportunities. Why is free cash flow payback better than PE ratio? So earnings can be easily manipulated through accounting tricks. Free cash flow presents real cash that's available to shareholders, and it works across different industries. So technicals, coal, and insurance companies. So this is just a word of warning. If you're using this approach on financials, use it sparingly, because they have accounting tools that they use which actually make it less reliable. If you're using this on financials, they will use amortizations and reserves and things like that. So use it sparingly. Right, so this is how I apply free cash flow payback in my portfolio. One example is Alpha Metallurgical Resources, AMR, my favorite stock. It's also one of Mohnish Pabrai's favorite stocks. They have a market cap of 2.51 billion and a free cash flow of 505 billion. So the payback is 4.97 years. This is quite attractive. It was actually quite lower than that last year. It was like probably 2 point something years, but the cash flow has fallen. This is a cyclical stock, so I can understand that. So, but it's still quite attractive. And then the second example is one of my newfound favorite. It's called Atlanticus Holding Corporation, ATLC. It's got a market cap of 863 billion and free cash flow of 479 million. Free cash flow payback is there for 1.8 years. So this is incredibly fast, and this is one of my favorite stocks, high conviction stocks. So I will be investing in this stock. I've got quite a little bit invested, and I will be adding to that position going forward. So comparing free cash flow payback across businesses, as I said earlier, MasterCard, I used to love this company. It's a great company, very good fundamentals, always growing. It's got a fixed overheads that are actually getting diluted by the growth in the subscriber base. But whilst it is a great business, it's quite overvalued because the payback period for this company, it was actually 50 plus when I calculated it late last year. I don't know what it is now, but yeah, that's quite long. 50 years, I'll probably be dead by then. So yeah, FCF Payback helps you to identify undervalued opportunities in stocks. So always remember to use this with other metrics. So don't use it on its own. The free cash flow yield, if it's above 10 to 12%, it's a strong buy. That's another metric that I use when I'm using this. Debt levels as well. I don't like companies that have got debt levels that are too high, because this increases the risk of bankruptcy and that company to go bust. There's also dividend and buybacks. So strong free cash flows are used to add shareholder value, and this will actually get more shareholder returns. So yeah, I will look at other things. I'll look at dividends. I'll look at buybacks. Buybacks are one of my favorites, and I'll do a video on that in the future. There are a lot of case studies which show that dividend companies that actually focus on buybacks and actually scrap dividends, they actually add more to shareholder value than anything else. So this is what I avoid when I'm using free cash flow payback. Companies with inconsistent free cash flow, I try and avoid these. So I've seen a lot of technology stocks, they've got very volatile free cash flow, so you can't really calculate solid and reliable free cash flow figure. What I'll also do is I will kind of like average free cash flow. Even for the consistent businesses, they will have a little bit of volatility, but I will find the average for over like 5 years or 10 years, and then I'll use that to calculate the free cash flow payback. So high growth tech stocks, many will reinvest all cash, making free cash flow temporarily low. So that's also the other reason why it's not very good to use that on high growth tech stocks. And then also cyclical businesses at peak earnings, it may not be sustainable because free cash flow is now going down from there. So the conclusion is that I will identify undervalued stocks based on real cash generation. The method also helps me to compare investment opportunities across different sectors. It also avoids businesses with weak cash flow despite strong reported earnings. I would rather have a business with weak earnings and high cash flow than vice versa. Then if I can buy a stock that pays back my investment in 5 years or less, I know I'm getting a great deal, so I usually go for that time frame. Or I will allocate more of my funds to companies that have a lower free cash flow payback. So this is it. This is the Value Investor, and we've come to the end of this video. Please like, subscribe, share, and click that bell for notifications in the future. And I'm hoping to do more videos in the future, so subscribe. Peace.